Greetings and salutations, everybody. Today we're going to talk about DeFi lending and how it works. As organizers started experimenting with blockchain's potential, the financial sector has also presented the need to build blockchain-based fintech applications. By covering almost all the financial services from online payments to cryptocurrency trading and storage, blockchain is set to transform the traditional finance system. With the emergence of DeFi, also known as decentralized finance, blockchain has grown to be even stronger. With lots of excitement generated already in the market, DeFi has kept powering ahead and attracted an impressive capital amount in just a few years. According to DeFi Pulse, the total value locked in DeFi protocols is at $20.46 billion today, up from less than $1 billion a year ago. The focus point here is that DeFi has grown more than 20-fold in a year, clearly indicating the amount of popularity DeFi has surged. The leaders have solidified themselves as the user's priority choice to lend and borrow DeFi tokens. The three biggest lenders for DeFi are Maker, Aave, and Compound, with a total value of $4.25 billion, $2.82 billion, and $2.64 billion, respectively. So let's understand what makes DeFi lending such a popular hit. In this video, we're going to discuss what is DeFi, what is DeFi lending, DeFi lending versus traditional lending, how do DeFi loans work, what are the benefits that DeFi lending provides to its users, how do DeFi lending platforms help the financial services sector, what are the most popular DeFi lending and borrowing platforms and protocols? Let's begin. So what is DeFi? In most simple terms, decentralized finance is an ecosystem of financial applications based on blockchain technology that operates without any third-party or central administrative intervention. It uses a peer-to-peer network to establish decentralized applications that would enable everyone to connect and manage their assets regardless of their status and location. It aims to provide an open-source, transparent, and permissionless financial service environment. Smart contracts are the foundation layer for decentralized finance, as they are self-executing and do not require intermediary oversight, and allow users to enlist their crypto coins on the platform for lending purposes. A borrower can directly take a loan through the decentralized platform known as P2P lending. Besides, the lending protocols allows the lender to earn interest. Among all of the decentralized applications, otherwise known as dApps, DeFi has the highest lending growth rates and is the most prevalent contributor for locking crypto assets. So let's talk about DeFi lending versus traditional lending. The underlying technology for DeFi lending is blockchain. DeFi utilizes all its unique features and performs exceptionally well compared to traditional lending. DeFi lending offers complete transparency with easier access to assets for every money transfer process without involving any third party. It provides the most straightforward borrowing process. The borrower needs to create an account on the DeFi platform, have a crypto wallet, and open smart contracts. The DeFi offers a censorship-free environment, meaning there is no preferential treatment while ensuring immutability. DeFi lending benefits both lenders and borrowers. It offers margin trading options, allows long-term investors to lend assets and earn higher interest rates. It will also enable users to access fiat currency credit to borrow loans to lower rates than decentralized exchanges. Moreover, the users can sell it on a centralized exchange for a cryptocurrency and then finally lend it to decentralized exchanges. So how do DeFi loans actually work? The underlying value of crypto assets may increase or decrease, but sitting idle in wallets doesn't accrue any interest. Just holding a particular cryptocurrency won't make any earning. It is the situation where DeFi loans come into the picture. DeFi loans enable users to lend their crypto to someone else and earn interest on the loan. Banks always have been utilizing the service to its fullest extent. Now, in the world of DeFi, anyone can become the lender. The lender can loan their assets to others and will be able to generate interest on that loan. This process can be done through lending pools, the loan offices of traditional banks. Users can pool their assets and distribute them to borrowers using smart contracts. There are various ways to distribute interest to investors. Hence, it is recommended and worth investing some time to research to identify your interest type. The same goes for borrowers, as each pool will have a different approach on how to borrow. While taking a loan from a bank, collateral is required that is associated with that loan. For example, a car loan. The car itself is the collateral. When the user stops paying the loan, the bank will seize the vehicle. The same goes with the decentralized system. Only the difference is that the system is anonymous and doesn't involve any physical property used as collateral. To get a loan, the borrower needs to offer something more valuable than the loan amount. Smart contracts are used to deposit this amount of currency of at least equal value to the loan amount. Collaterals are available in wide varieties. Any crypto token can be used to exchange borrowed cryptocurrency. For example, if a user needs to borrow 1 Bitcoin, he needs to deposit the price of 1 Bitcoin in DAI. Furthermore, the prices of Bitcoin keep swinging wildly. A case may arise when the cost of collateral drops below the price of the loan. Now, here's the question: how to deal with this situation? An example could explain it better. Let's say a user wants to borrow 100 DAI. MakerDAO requires borrowers to collateralize their loans at a minimum of 150% of the loan value. This straight away means that the borrower needs to collateralize the loan with $150 in ETH. And when the value of collateral reduces below 150 ETH, it becomes subject to liquidation penalty. Now, what are the benefits that DeFi lending provides to its users? First off, you have improved loan organization speed. Digitally enabled lending processes have the most significant advantage of fast processing speed. DeFi lending platforms are backed by a cloud-based service, analytics for fraud identification and detection, and machine learning calculations for optimum loan terms and risk factors. All these technologies eventually help to speed up the process. As soon as a loan is approved, lenders send offers via e-contracts. You have greater consistency in lending decisions. Rules describing credit policies guarantee consistency in lending decisions. Variations on evaluating applicant attributes and structuring deals by underwriters are eliminated. You have compliance with federal, state, and local regulations. Decision rules provide a record of who, when, and where the rules were used and which rules were in effect. It plays the role of evidence and ensures that the lender complies with federal, state, and local regulations. Analytics for process improvement and portfolio profitability. Analytics can help lenders and borrowers get the most out of the digital lending process. Monitoring loan applications over a particular duration, such as like a week, a month, or a year, can help lenders anticipate and allocate proper resources to accommodate seasonal demands. Analytics also provide insights into demographics, loan sources, credit tiers, etc. The portfolio can be improved by determining how borrower characteristics and credit policies can affect loan performance. Also, it's permissionless. DeFi lending allows open, permissionless access, meaning anyone with a crypto wallet can access DeFi applications built on blockchain, regardless of their geographical location and without any minimum amounts of funds required. Then you have this transparency. The public blockchain broadcasts every transaction on the network and is verified by every user on the network. This transparency level around transaction allows for rich data analysis and ensures verified access to every user on the network. With immutability, blockchain's decentralized architecture ensures tamper-proof data to coordinate and increase security and auditability. With programmability, smart contracts are highly programmable, automate execution, and enable the development of new digital assets and financial instruments. With the interoperability, the use of interconnected software stack ensures that DeFi protocols and applications integrate and complement one another. With the self-custody, the use of Web3 wallets like MetaMask ensures that the DeFi market participants keep strong custody of their assets and control their data. So how does DeFi lending platforms help the financial service sector? With lending and borrowing, savings, and asset management. The most widely used DeFi lending applications involve peer-to-peer lending and borrowing protocols. Aave, Compound, and Maker are a few of the most popular DeFi platforms. DeFi lending platforms have come up with numerous innovative ways for people to manage their saving. By plugging into different lending platforms, users can avail themselves of the services of interest-bearing accounts and maximize their earnings. Interest-bearing accounts can help the user to increase their profits when compared to traditional savings accounts exponentially. The most popular savings dApps include Argent, Dharma, and Pool Together. DeFi lending protocols and crypto wallets like Gnosis, Safe, MetaMask, and Argent enable users to be custodians of their crypto assets. It allows users to quickly and securely interact with the decentralized apps and avail services of buying, selling, transferring crypto, and earning interest of investments. And as I said, Maker, Aave, and Compound are the most popular DeFi lending and borrowing platforms. Maker is a unique DeFi crypto lending platform that allows borrowing only DAI tokens. DAI is a stablecoin whose value is pegged to the US dollar. Anyone can use the Maker to open a vault, lock in collateral with ETH or BAT, and generate DAI as debt against the collateral. It encourages users to participate in operational earnings through governance fees, which act as interest rates for the network. DAI can be borrowed up to 66% of the user's collateral value. If the vault falls below the fixed rate, it becomes subject to a 13% penalty in liquidation to bring the vault out of default. At a 3% discount, liquidated collateral is sold in an open market. Maker's other token is MKR. Holders of Maker act as the last line of defense in case of black swan events. If the collateral value starts to fall, Maker is minted and sold in an open market to raise more collateral, diluting Maker holders. Maker's Oasis portal is the most important place to use Maker DAO, allowing opening, managing, and reviewing vaults. Deposit DAI into DSR, the DAI saving rate, and get updated stats on the entire Maker system. Now, Aave is an open source and one of the most popular DeFi lending protocols launched in 2020. It is a non-custodial liquidity protocol for earning interest on deposit and borrowing assets. This platform allows lenders to deposit cryptocurrencies in a pool and receive an equivalent amount of A tokens comparable to C tokens of the Compound protocol. Aave algorithmically adjusts interest rates depending on demand and supply. It indicates the more the user holds A tokens, the better the interest amount. Now, Compound is an algorithmic and autonomous money market protocol intended to unlock a universe of open financial applications. It allows users to deposit cryptocurrencies, earn interest, and borrow other crypto assets against them. The use of smart contracts automates the management and storage of capital on the platform. Web 3.0 wallets such as MetaMask allows users to connect the Compound and earn interest. It is a permissionless protocol, meaning anyone with a crypto wallet and an internet connection can freely interact. Recently, Compound launched its governance token, COMP. It provides voting rights to token holders over things like the decision to incorporate new assets, protocol upgrades, or technical upgrades on the platform. Compound's native tokens, called C tokens, are used to track positions, supplied assets in Compound. Those tokens are ERC20 tokens that display claims to a portion of an asset pool in Compound. For instance, when a user deposits ETH into Compound, it is converted to CETH. Likewise, if a stablecoin like DAI is deposited, it is converted into CDAI. In multiple coin deposition cases, they will each earn interest based on their interest rates. It means CETH will earn a CETH interest rate, and a CDAI will earn a CDAI interest rate. Compound Finance supports various lending and borrowing assets including DAI, ETH, WBTC, REP, BAT, USDC, USDT, and ZRX. In conclusion, this detailed discussion shows that DeFi lending has a high potential to reshape the entire financial system. It attempts to decentralize the core traditional finance services like payments, trading, investments, insurance, lending, and borrowing. DeFi lending being involved with the intriguing technology truly has vast opportunities to revolutionize the global financial landscape. If you're looking for a blockchain development company to build custom DeFi lending applications, we're ready to help you. Get in touch with our experts and experience your idea of developing DeFi lending apps getting converted into reality here at Leeway Hertz.